Principles of Accounting 2, Chapter 10, we're going to take a look at a comparison of the three depreciation methods that we have been learning throughout this chapter. P7 from your textbook says that we have a company that purchased a computerized blueprint printer that will assist in the design and display of plans for factory layouts. The cost of the printer was $22,500 and its expected useful life is 4 years. The company can probably sell the printer for $2,500 at the end of the 4 years. That $2,500 amount is our residual value. Then it tells us the printer is expected to last 6,000 hours and that it was used 1,200 hours in year 1, 1,800 hours in year 2, 2,400 hours in year 3, and 600 hours in year 4. So we are required to calculate the annual depreciation for 4 years under each of the three methods. So the first method you see here in front of you, the straight line method, and we have it neatly divided out in years 1, 2, 3, and 4. So the $20,000 you see there that has a star by it under the computation is our depreciable amount. So our depreciable cost is the $22,500 that it cost us minus the $2,500 residual value that we are expected to receive when we're finished with it after 4 years. So we take our depreciable cost divided by 4 years, and each year we will record depreciation in the amount of $5,000. You can then see here where it shows us that we are calculating our carrying value. So the carrying value is your cost minus the balance of your accumulated depreciation account. So this is not 20,000 minus 5, it's our 22,500 minus 5,000 gives us 17,500. So then for year 2, we subtract out the next 5,000 and then the next and then the next, and you'll notice that the carrying value at the end of 4 years is equal to our residual value. Now under the production method, we take our depreciable cost times the number of hours the printer will last divided by, the number of hours that it was used in year 1 divided by the total hours that it will last. So this equation is a little bit different, not different, it's organized a little bit differently than what you've seen in the past. In some of the other examples, it may have been 22,500 minus 2,500 divided by 6,000, then divided by the 1,200. But it's basically the same thing, it's just putting it in a different format. So we come up with $4,000 for our annual depreciation the first year. And so then our cost, $22,500 minus our accumulated depreciation gives us our $18,500 for our carrying value. Now it's important that you understand and can calculate carrying value because you will be doing it for the rest of this course. So for year 2, we used 1,800 hours. So we used that in our calculation, came up with 6,000. So we took our previous carrying value minus our 6,000 to get our new carrying value. Same with year 3 and year 4. Now for the double declining balance method, keep in mind that the residual value is not accounted for until the last year. So we start with our cost and divide by our 50%, and you can see here that 50% was based on 100% divided by the 4 years equals our 25%, then times our 2 because it's double declining balance equals 50%. So 50% of our cost, which remember in the first year your cost is your carrying value because the equation for the double declining balance method is cost times carrying value times our rate. So our depreciation is $11,250, and it just so happens, this is coincidental, that our carrying value is the same because we take our cost of $22,500 minus our accumulated depreciation gives us our carrying value. So then our new carrying value is $11,250, so we carry that down for year 2 and take that times 50% to get our depreciation for year 3. So then our previous carrying value minus our depreciation gives us our new carrying value. So then for year 3, our new carrying value, $5,625 times 50%, gives us $2,813, and we rounded a little bit there. So previous carrying value minus the depreciation gives us our new carrying value. Now you'll notice in the fourth year we cannot take 50% of 2813 because then we would end up with a residual value, a carrying value that is less. So we have to take our previous carrying value minus our residual value. So the amount that we can depreciate in the last year is only $313 because this number, our carrying value, cannot fall below our residual value because we cannot depreciate our residual value. So the next part of this is looking at whether we have a gain or loss based on if we're going to sell. So to calculate gain or loss, you're going to take the amount, you're going to take the carrying value, sold for $12,000, you're going to take the cash received minus the carrying value in each of the methods. So we're doing this after year 2. So if I scroll back up here, after year 2, I have a carrying value of $12,500 in the straight line method and the production method, and a carrying value of $5,625 in the double declining balance method. So I'm going to take the $12,000 cash that they're given to me, and I'm subtracting out the carrying value. So the carrying value means that this asset is worth $12,500 on the books, and I'm only getting $12,000 for it, so I have a loss of $500 for both methods A and B. Now, however, in the double declining balance method, I'm receiving $12,000 for it, but it only has a book value of $5,625, so I'm actually recording a gain of $6,375.